So I don't know about you guys, but there's talk of, are we in an AI bubble? Stock prices have been just through the roof. Price to earnings ratio is, insane. But the job market is crazy. Gold and silver, these assets have been going off crazy, and I don't know. It just feels like there's just so much that's kind of going on, and for a long time, I felt just like I didn't really understand or didn't have a good grasp of what's kind of going on in our economy, what's going on in the things that drive the stock market and in our investments, so that hopefully, I can be confident in what I'm doing. And I mean, granted, you're never going to have the crystal ball, but to just be an educated investor, be an educated individual, as it pertains to how we plan for our retirements and our investment accounts and the money that we make. So what this video is just kind of a walkthrough of a tool that I built, just kind of share how I built this, and not from a technical perspective, but just kind of like what are the questions I'm asking myself, and how I'm kind of using this. And this is basically just a page on my personal website that I've kind of built, just an extension of just some of the cool things that I like and passionate about, that I can create and refer back to it. So this is my finances tab. And what this is basically does for me, this is a spot where I have customized. There's a bunch of different graphs in here, and I'll walk you through some of this stuff. And if you've taken a economics class, especially macroeconomics, a lot of this stuff is very related. And as I was going through creating all these different graphs, which basically give different snapshots, viewpoints of what the economy is like, and where different indicators of kind of the health of the markets and different markets. It's amazing. As I was going through building this, creating this, amazing learning all this stuff. It's basically a bunch of graphs. All these graphs are updated kind of in real time, but they all give a very distinct viewpoint and lens of what the economy is doing. And so I have this is organized where, let me show you just the broad picture organization. So I've pinned kind of a couple quick view charts. This is gold and silver, if you've noticed, but silver's been crazy hot investment recently, and as well as gold has been, and I was doing some investments in that space. So this was something that I was tracking daily, that I would look at to see when to offload different positions. But so quick view charts, that's the only one I have in there. Fed statements, this is the direct links for when the Federal Reserve will post important things about what they're doing, in terms of basically printing money. So I'll just take this as an example. You go here, and this is the statements, all their releases. So they had a couple statements, and they had one just today on February 23rd. But for example, they don't have them a lot, right? But some of these are kind of big indicators. For example, I'll click on this one, December 10th of 2025. And in this one, they talk about going forward, the standing overnight repo will no longer have a operational limit. So what this is kind of saying is like, hey, if our economy is in a tough spot, banks can use this overnight repo thing, which I won't go into that, but basically there's no cap on how much safety reserves can be that banks can kind of tap into if they need liquidity. And it's kind of interesting, right? Like, well, they used to have a cap on this. It used to be, I guess maybe 40 billion that could be accessed. Now there's no cap. But this is where their key updates are. The Treasury purchase schedule. So this is directly related to if the Fed is going to be deciding to use its power to purchase our own debt back. So we would be, do we print money to purchase our own debt? This is the direct link to the schedule for that, which is very telling of what our government is deciding to do. So here's the Treasury security schedule. This link goes to a search. But what this tells is, on these operation dates, for example, in this time, they will purchase a maximum amount of $8.3 billion. And this is on the 20th, and they can do that on the 22nd, the 26th, 29th, the schedule. So every couple of days, they're built, these bills, these 1 to 4 months. So, they say what this is. But basically, they're buying, Federal Reserve is buying its own debt back. And if this is like ingesting liquidity into the system. And I think the highlight of this was you add up all these here, and they're starting at every month buying $40 billion. $40 billion of our own debt by printing money. And that is, what does that do? It's asset inflation. And it's the raw facts. Like, this is right from the schedule, the Treasury's securities operations schedule. And I think it's good for me. Like, I want to know what the facts are. You read things in the Wall Street Journal, you read things on the news, whatever, and they can twist things into however they want to twist them. It's amazing what that can be like, and I am not about it. I'm sick of it. I'm done with it. Give me the source. Give me the facts. This is what this is. So this is kind of aggregate key things, Fed statements. Other piece in here is before I get in there, getting a little ahead of myself, the structure. Key statements from the Federal Reserve. I've got the CME FedWatch tool. This is it's kind of a pooling of all the different investors and what they think and economists, what they think the federal funds rate will be. Give me 1 second, I just get it. But a very useful tool for seeing what they expect our interest rates to be for the economy. Interest rates lower, stocks go higher. As interest rates, when they quantitative tightening, they're raising interest rates, which was just happening to us more recently. The stock market reacts as money is more expensive. It's not easy money. And then what does the job market look like? This is big because, that's one of the biggest things that the Fed looks at, the health of the labor market, and determining whether they will raise or lower interest rates. And that's all then tied into liquidity here. So these are just kind of some of the key facts, current pulses of where we're at and what the Fed has released, different schedules, like I said. And then a section on the U.S. liquidity. This is liquidity as basically, are we in an environment of easy money, or are we in an environment of tight money? When money is cheap, it's easy to come by money. Businesses can invest in new operations. They can hire more people. When interest rates are high, they can't just do that, right? Because it's expensive. It's more expensive for them to do that. They have to take out a larger loan, and the Fed funds rates, it starts at the banks, and what the banks will loan, but the banks, they always got to make their profit. So from there, if you're taking on a mortgage, there's a Fed funds rate, and your mortgage rate is higher than the Fed's fund rate because the bank's got to make their percentage. And for businesses, when they're if they want to get a loan on a business, well, that's riskier oftentimes than when someone gets a home on a loan for a mortgage. So that interest rate premium is even higher. So where that baseline starts is a big deal, and that is all tied into liquidity, right? How easy is money in the economy. And then the relative value. This is kind of where everyone wants to be. What is, I have this where to hide and rotate. It's kind of a way of thinking of like, all right, well, are some asset classes overvalued or undervalued? And the big beachhead of that right now is like, is the S&P 500 or the NASDAQ, is that overvalued, undervalued? And right now, gold, the metals, is that over or undervalued? I mean, like, let's get some precision. This is what this is about, is having some stability, some precisions that I can go here, I can get the facts, I can look at it, and I have a very select group of charts that I have created very nice descriptions for that I understand, to understand, objectively as things are moving, okay, this is where the economy is. So I'm gonna just jump right in, because the other thing that's kind of cool, the way that I organize this on my site, is it's meant to be read top down in kind of the flow of how I would use it. That's how I designed it. So went through some of these statements. I am going to go into the CME FedWatch tool, because if you've never been here, this is actually really cool. This is a really cool tool. And what this shows up here, these are the different dates of when the Federal Reserve people come and decide whether or not they're going to cut interest rates, keep them unchanged, or raise the interest rates. And that's kind of this bar here. What's the probability? So for the March 18th, there is a 5% chance, based on these different accredited individuals that allowed to vote, there's a 5% chance that interest rates will go down a quarter point. Most people say it's going to be unchanged. Where it gets interesting is, now let's go out. This is in April, June. Let's just go to July, because there's a new Fed chair that's being introduced. And now we see, okay, now there's a 0.25% chance it's going to be unchanged. 75% chance that there will be easing, meaning the lower interest rates will drop. If interest rates are dropping, money becomes cheaper, asset inflation, everything from gold to stocks to real estate will, necessarily go up. The balance that the Fed does is they're balancing not just, inflation and what inflation's doing, but also where is the labor market. So it's those two things. I do not have a graph on here on inflation, because there's real and then there's the kind of headline inflation, and then the real inflation, also very good things to kind of keep a tab on. Maybe I'll add that in here. So, but the key thing here, this is a phenomenal tool, and I just can go to it. Okay, what is the, what are the different probabilities at different times? What does this kind of tell us? And now what's interesting about it is, in this site, is that the same type of information you'll see, certain graphs will be supporting or contradicting that information. And that's the part that's kind of interesting. This is the exploration of analyzing what these graphs really are telling us. So I'll just start with the 2-year Treasury yield. And this is a classic indicator of what do markets expect next. So the 2-year Treasury yield shows what investors expect interest rates to be over the next few years. When it rises, we expect tighter policy. So let's look to show that on this graph, because mapping this last couple periods makes a ton of sense. So this is 2020. We had the cheapest interest rate possible, right? We had like a 0 interest rate, and the 2-year yield was nothing. After that, After that period, we started tightening, raising the interest rates significantly. This increase here shows the tighter, our tighter policy. And you can see this general downwards trends all the way from the 80s till now of just a looser, cheaper money policy. Very interesting. And now the question is, you look at this trend here. This is where in the CME FedWatch tool we looked out a couple months. It says they're saying 72% probability of interest rates are getting lowered towards easy money. As this is us heading us down this way. And as many of us know, it's been kind of headline news recently that a fifth of our nation's budget, this is about $5 trillion, so just around $1 trillion of that is going towards interest payments on our debt that we're servicing. So when our government is deciding to, this is in this Treasury purchase schedule, and they're deciding to purchase our own debt by printing our own money, that is not ideal. That is not good. And that amount, $1 trillion out of $5 trillion, that's even more than our spending on military. That's scary. This is the point, and these are some of the reasons too where I'm like, I want to understand what's going to happen and get a pulse. Because if things start hitting the fan, I want to be prepared, as someone just as a living and wants to raise a family. Like, I want to be prepared so that we are not just in a terrible situation financially. So anyways, this is saying indicator here to your treasury yield looks like we might get a tighter or a looser monetary policy. What this graph shows. Now you've got the yield curve. This is liquidity allowed or blocked? So this is now one thing I have in here, some of these indicators are leading indicators and some of these indicators are lagging. What that means is whether or not it is a lead for something to happen in the future or whether a lagging something that confirms something that already has happened. So it's kind of how this is organized too. Your leading is in the front, something looking forward, and then as it goes towards lagging. So your yield curve. So this is the 10-year rates. So debt interest rates, that is looking further out, minus the 2-year treasury, shorter. And what this tells us is whether or not liquidity is allowed or blocked in the economy. So the spread between the long and the short-term treasury yield shows how tight or loose financial conditions are. I think the best way is just kind of describing in this 2023, 2022, in this zone, this was when we had, Silicon Valley Bank went under. And the financial, conditions, they got way tighter. They tightened it down, and money was tight. Now, let me move this out. When the spread is negative, which is inverted, and we are at an inverted yield curve, typically signals recession. Short-term rates are higher than long-term rates, and you'll hear. So many people you're interested in finance stuff, the yield curve's talked about a lot. Short-term rates are higher than long-term rates, signaling tight liquidity and higher recession risk. That's what we were in. This is why everyone was freaking out for so long, from 2022 into now, into 2024. But as many of us know, stock market just flew right up, right? So but we did have tighter liquidity. It was a big thing. Mortgage rates increased to highest levels that they've been in a super long time. But now that we're up here in this positive and the trend is going this way, we are kind of we've been opening the floodgates of liquidity. We're not, money is being allowed to flow into the economy. Okay, signaling tight liquidity and high recession risk. as markets expect, future rate cuts. Now, we're not in the negative, so anyways, when the spread is near zero or flat, constrained but transitioning, when this trend is positive and rising, I would say we're at positive and rising. Short-term rates are falling relative to long-term rate, indicating easier credit conditions and more supportive environment for economic growth and risk assets. Basically, we're getting signaling easier money, more supportive environment for economic growth. So businesses are going to invest in more and buy more, and we've seen that in AI. We've seen those data centers, big data centers. But this trend is still kind of going up. Is it going to flatten? I don't know. But that's, this is the facts. Federal Reserve balance sheet. This is a big one it's kind of the U.S. liquidity now. Policy action in real time. So this is real time. This was still leading. This is real time. Chart shows the direction and intensity of Federal Reserve liquidity policy. Rising, not economic strength, this is different. Rising assets means the Fed is injecting liquidity because we're buying our own debt. While falling assets mean liquidity is being withdrawn, we're tightening it up. So we saw that here where, now this is, we just get the tick here, 2026. This is updated a couple days ago on the 18th. We were in, so falling means liquidity is being withdrawn. But now as we're rising, we're kind of starting this. This is the, go to the statements. You say, they're going to be buying $8 billion every couple days, $40 billion in January, February. The balance sheet is growing. We're buying more. And this is a great indicator when you see, like in 2020, we had the COVID. Oh, what was happening? The Federal Reserve was stepping in. We were buying so much. We were increasing our balance sheet. Balance sheet meaning the Federal Reserve, a separate entity, is buying the U.S. government's debt. It's putting it on the Federal Reserve's balance sheet, which is just stimulating the economy. They're stepping in, and it's been going downwards recently because we had that tightening, and now the question is it going to keep going up? And that's where you look at the schedule of what they're going to say they're going to do. So I would expect this to keep going up, $40 billion a month. And then this reverse repo facility. This is where is excess cash sitting? So this is interesting and useful because this is kind of a way that I would kind of think of it as like reserves for if something goes wrong. And this, if you notice, which I find very interesting, is this was a new initiative. This is after the 2008, 2009 financial crisis. This is a whole new thing. This is like they did it because of this. And, we had some reserves, a couple reserves here and there. Okay, 2019, things were a little worried, I guess. They depleted those reserves down to zero. But then 2020 happened. Whoa, and we were freaked out, right? The government was like, we need money to help with things because they're super worried. So they put in they had $2.5 billion almost into the reverse repo facility that the government ingested this money in, burned it up. Now we're back at zero. So where is excess cash sitting? Tell you what, it's not in the reverse repo market. Real interest rates. Is money cheap or expensive after inflation? Really important to look at. Best way to look at this is looking at, in 2020. 2020, 2021, this is the cheapest money you're ever going to get. This is why people have 3%, 2.9% mortgages. Cheap, easy money. We raised interest rates. Now we're not quite there. Now this is, adjusted for, like I said, it's after inflation. This is the indicator. We've had a little bit, when was the time? There was that period where it was interest rates are maybe still low, but you got inflation. So it balances out for both of those things. Okay. But real interest rates is really key. And when it's high, when real interest rates are high, cash and bonds, they compete with gold and stocks, because you can get 4% in a savings account. They had that like last year. You could get like 5.5%. A lot of people are doing that for a little bit, because before that they're like, whoa, you couldn't get that guaranteed return. You got 0.1%. M2 money supply. This is how is new money spreading? Total amount of money circulating in the U.S. economy, including cash, checking deposits, and anything that's very easily convertible to money. Boom, same theme. Look at all that. Look at all that increase in money supply. All that money being added to the economy. I mean, we are at a certain rate, and we're just going parabolic. And the question is, is this going to keep going up? And it's like, well, it can't go down because we have all that debt. So this is something good to kind of keep a tab on. And very fascinating. Money market funds, total assets. Well, all right. People are saying like, all right, well, man, do people even have money to invest in stuff right now? Money market funds, whoops, sorry about that. Money market funds, total assets. So this is cash, right? This is not your S&P 500. Total amount of money in money market funds. It's a proxy for how much cash is available for investors to spend. It ain't me, but apparently right now people have got more cash than ever. That's some wealthy folks have a lot of money right now. And you look at this. This went down here. Very interesting. This was our 2008, 2009, like total money amount, total money. Everyone like boom, lost a ton of money. Powerful indicator, okay. But here, we thought everyone was going to be losing money, and then we all got stimulus checks, and I tell you, we're not. There's no indicator of this. We're so much money. So what is this like? I look at this stuff. What is it telling me? Well, when you think about the big picture, and this is why, and I don't get this is necessarily one video, right? Like you learn more. It's you're reading the news, you're understanding, but you're trying to get a sense of like, where is the sense of the U.S. liquidity at? And I look at these things, it's like, well, there's a lot of money here, okay? The money supply, boom, this is keep going up. Interest rates, we're at a little bit higher rate. Now, some of these will feed into the next graphs, but without a doubt, money is flowing through the economy. You look at investors, CME Federal Watch is expecting lower interest rates in the future. And it looks like the money floodgates are going to be open. That's what it looks like. And no one, everyone's figuring out what the new Fed chair is going to do. And then I go to this link, but you look at the jobs report. Now this is very, very insightful, especially when we look at the 5-year trend. This is our state of our jobs market. New jobs added. It ain't looking too hot recently. This is the last 5 years. That's just a fact. What's interesting is this is October. Every couple months, they revise certain numbers back. They revise them. I don't know what this posting was originally, but, and this is kind of, a contradictory thing that everyone's kind of been talking about, is like the January job posting was plus 130,000 jobs. At the same time, they added that, which that is a strong number from where we were at recently. At the same time, they revised October's numbers from, I don't know, 0 or whatever it was, down to negative 140,000. So you look at this, and it's like, wow, this looks really promising. But you talk with other people that are trying to find jobs, and it's like, oh man, yeah, they're really struggling. And it is. It's a tough market out there. Everybody knows it. Everybody who's a normal person knows that it's a tough labor market. So the question is I see these numbers here that this 3 months looks like a good trend, but they have not revised this number yet. They have not revised this number yet, and they have not revised this number yet. After these numbers get revised, is the overall trend going to go look like this? And this, because of this, inflation's been lower. But you look at this and you say, uh-oh, job market might be in a tricky spot, which is supportive for the feds to lower interest rates. There's two things they look at. One, they look at our inflation. Cost of energy has been so low recently, almost kind of uncharacteristically low, but that has been keeping that inflation number lower, maybe lower than what it normally would be, because going to the grocery store is very, very expensive. So you pair that inflation information. If inflation rose a lot, then they would have a case and they would be saying we need to keep interest rates high. But headline inflation has looked very low. And you start to see this information, or this downward trend, this is supportive for them to continue and cut interest rates, which is what you see with all the other graphs. And when you start to see this full picture, it's like things start to make sense. Because I've been recording this video already quite long, I'm not going to go too in depth into the relative value. I think it's very, very, it's more straightforward. Okay, this is kind of, anyone who just keeps tabs in the investments, this orange line here has been gold. Gold is just right out the moon. This is our M2 money supply, the green line. Staying up, money flow, money printing. It's kind of interesting how this green line kind of loosely tracks all these other lines. This little dip, market went down, gold went down, as we rose a little bit, kept our money supply constant, markets just launched. So that's why I do liquidity. That's why I have a bunch of graphs on it. You got the S&P 500 relative to gold. My philosophy, what I was thinking is, you got some metals, you got gold, you got Bitcoin, you got maybe different oil, you got real estate, and all these things. It's kind of like, what is their price relative to each other? And then a couple other indicators on, let me just go through. S&P 500 to gold ratio, pretty straightforward. I'm not going to really talk about this. S&P 500 PE ratio. I am going to talk about this. This is a question of are we, are we in a bubble? That's the question. Are we in a bubble? The average, put this in here, 16.2 PE ratio. That means your price of the asset you're paying for, price of the stock relative to its earnings. What's kind of nice about that is both price and earnings, as inflation rises, they both go up. So if inflation rises by 10%, the price of your stock will increase by 10%. Price of your earnings will increase by 10%. So the ratio should be about the same. This is a big thing. Warren Buffett, if you read Intelligent Investor, historically 15 is anything below PE ratio of 15 is a good time to buy. Yeah, we haven't seen that since a long time. We're at almost 30, and you look at this line and you say, wow, when was the last time we were up here? This is the dot-com bubble. Great financial crisis went out of this world. And sometime in, where is this? We got up to, 30, 39. And it did drop down to 20. But now we are at 29. This is where our PE ratio of the S&P 500 is. This next graph is probably the most insightful graph that I kind of created here. It is the earnings of the S&P 500 ratio. But you do the inverse of it. So instead of PE, it's called the earnings yield, which is just earnings over price. But it captures the same thing. It's just the difference is that instead of here, this is like sell when it's high, and low buy. It's the opposite. So when it's high, you buy, and when it's low, you sell, because ratios flip. But it's adjusted for the real cost of money. The real cost of money is your yield curve, which is the 10-year minus the 2-year. The reason we invert this PE ratio is because then you can take this value and subtract this value and get something that makes sense, because your earnings yield is a percentage. This is also a percentage. You can take them and minus them, so it kind of adjusts for the real cost of money. Unfortunately, this can only go back to 2004, this data. But this is the average. The average is 3.66 now. And here I got a little indicator. Okay, this is above 5%. Stocks are cheap. So here's 5% line. So believe it or not, this is 2022. This is when that PE ratio was just around 20%. Stocks were very, very cheap because you had also relatively cheap money and the price to earnings ratios went down. Now here, what's interesting, well, let me actually go to 2020, like 2012 in this zone over here. This was like the best buying time because you had the interest rates, real interest rates were very low. So money was cheap. But at the same time, the PE ratios was also very, very favorable. So this put us at just a historically out of this world time to buy. And the reason this doesn't, you compare this dip down, which is like, well, why doesn't it look like, this just, well, I guess they are kind of the same. Scratch what I said. But what is very interesting, what this graph will show here, is even in 2020, in this zone, when your PE ratio, let's get the date here, okay? December 20. PE ratio was 39 at a still historic high, scary high, even at this date, December 1st of 20. Okay, December 1st of, October, November, December 1st of 20 here. We were still in a buy zone. Sorry, November, December. It dropped down a little bit. This is still a buy zone. I mean, we're kind of in the middle, but the reason for it is like money was so cheap. Money was so cheap. So even though the PE ratio was like historic high, crazy, crazy high, money was so cheap. But now where are we? We have been floating in this zone where PE ratios are, we're not up to that peak, but we're pretty darn close to it. But money, cheap. Money is not cheap. Now this is for the S&P 500. And, everyone kind of can interpret this differently. But if interest rates go down and money becomes cheaper, this will go up. But if companies are performing and their earnings are not hitting, I mean, Microsoft's earnings recently did not meet expectations, and it was a big thing. If earnings are not keeping up with the price, this is getting even more towards overpriced. And this is what's scary to me. And this is, where it's like, well, how much more? Like, what do you do with the S&P 500? And this is, I think, partially why, gold and silver has been so crazy, because you've got the U.S. government used to be, the most secure asset of all time. China used to buy our debt, and everyone was in the dollar. Everyone's in the dollar. But recently, you've got now, from being the U.S. perspective, the value of the dollar is going down because we have so much debt, and no one is buying our debt. So it's costing us more of our $5 trillion to kind of pay our debt expenses. And for all the countries that used to be buying our debt, what are they buying instead? They're buying, gold. It's the safe haven for when things are unstable. And there's no other country that's currently like number 2 to being the reserve currency. China or Russia, they can't quite be, the natural, the reserve currency. There's a bunch of talk about who's that's going to be, or what that's going to look like in the future. The only fact is it's not the U.S. dollar. So you've got all these governments, all these banks, everyone is flooding to gold. Dollar's going down and they're seeing gold, and you compare gold to Bitcoin, and it's like, well, gold is time tested, Bitcoin hasn't been. We're in a state of uncertainty. No one's head knows what's going on. We also got some different wars, so people are flocking to gold, which is kind of where to the question then of how much further could gold go? Like, where the heck are we? Okay, well, .com bubble way up here. Gold was like, this is S&P 500 relative to gold. Gold was, I guess, really cheap, and stocks were insanely expensive. Average here, 1.66. We are a little bit below this, meaning that gold has been kind of outperforming the market. Well, not outperforming. I mean, it's priced relative to each other. But we had this period, man, from the 70s all the way until the 90s, where, gold was getting way down here. It was so much more valuable to hold gold. And that also kind of happened right after the great financial crisis. No one was sure what was happening. Gold got way down here, and relative to the S&P 500. So you look at a graph like this, and it's like, okay, well, we're here. Yeah, it's expensive, but to me, just looking at this data, I don't see any reason why we couldn't be down in this zone. And it's not new uncharted territory. I mean, everything reverts back to the mean, but I mean, we've had some periods up here. You know, here there was a big period down here, period down here, way up here, zone down here, period here. We're kind of entering this new territory. I think it's insightful. And gold to silver ratio. This is just gold to Bitcoin. I'm not really going to talk about that. And the last one, I'll just mention U.S. price to rent ratio, whether it's more economical to rent or to buy our home. Higher ratio suggests housing is overvalued. This was 2006, 2007, before this big crash, and it was better to buy a home. Man, we are right up there. So, I mean, everyone who's trying to buy a home, it's a struggle. It's a big struggle because price to rent ratio. So you also look at it from an investor's perspective. Are you going to buy a rental income? Now, real estate's local and this and that, but buying houses is not very easy to do. That's some obvious news, but you know, I wanted to have it in here, right? Maybe this starts to trend downward. I don't know, but it's kind of cool. So that was a long walkthrough. Something I wanted to do though. Let me know what you think. I mean, it's just a cool tool I can add, you know, update the descriptions and customize this however I want. I look at this and I say like, hey, how's our economy doing? And as I learn new information, I learn something. Someone talked about something. It's like, oh, that's really powerful. I should remember that. I have a spot. I put it somewhere in here, right? So, okay, if you made it this far, you're a trooper, and leave me a comment of what you thought, or some things, or questions, or anything. First time I'm kind of sharing this. So, all right, have a good night.